All right, welcome to the show. Let's get the disclaimers out right away. eWealth Partners is an investment advisor registered with the state of Minnesota. The information in this podcast is educational in general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice, and to determine which strategies or investments may be suitable for you. Consult the appropriate qualified professionals prior to making a final decision. So today I want to welcome Caleb Schmidt, partner at Duco Capital. Welcome to the show, Caleb.
Yeah, no, thanks, Brian. Thanks for having me. It's my first podcast, so I'm excited to get this done.
Okay, well, if this is the first go around, you better not screw it up. You better be exciting and entertaining for our guests. But I do think our topic is actually very interesting to the clients that we serve, the clients that you work with, all around kind of private equity, kind of like what does that even look like? With our clients, we're getting more of those. Hey, when does private equity become that potential buyer for our business? And we thought, just with how niche Duco Capital is into that kind of right, because you guys target more of the manufacturing businesses. Maybe just give us a little overview of who you guys work with, or your target, I should say.
Thanks, Brian. So yeah, we target lower middle market manufacturing companies, 2 to 5 million in EBITDA. And the way we try to differentiate ourselves is that we really lean into leadership transitions. So companies with owners who would like to retire immediately or in the next year or two.
Okay, so otherwise, you want them to get out of the business.
Yeah, I mean we're open, right? I think I think we're good partners either way. What we've tried to do is develop a strong network of leaders and CEOs that are ready to step in and help facilitate that transition. So we're going to be more competitive in deals where there is a leadership transition element. But that's not to say that it's a requirement, right? I think we could be a good partner either way. Um,
Is it
I
fair
think
to say that other private equity, they actually might, they're gonna target the business owners that would want to stay on?
Yeah, I think, you got to think about it. Everything's a risk calculation, right? And so, for a lot of private equity, especially at the, lower end of the middle market, they're just not willing to take that kind of risk on to, transition the business, whether or not it's the relationships that transitioning those, that's going to give them the heartburn, right? So again, it's more about where can we be competitive on our valuation. We feel, good about taking those transitions on and mitigating some of that risk.
Okay. So let's back up actually just a little bit. And for those that just define private equity, so they're a potential buyer of your business, right? And it's not going to be maybe, one idea was you're going to transfer it to a key employee, right? Maybe that's a key employee that happens to be a family member, or maybe it's your competitor, right? But like maybe just define for the first time for who's private equity and why are they a potential buyer?
Yeah, I like to think of sort of the analogy that there's a lid to every pot, right? There are all different types of businesses out there, right? And in a similar way, there are all different types of buyers, right? And frankly, there are even all different types of, well, there are a lot of different types of private equity buyers, right? Different private equity groups that specialize or have some expertise in different industries, or they're looking for different types of companies. So private equity buyer just kind of fundamentally is is a sponsor, right? A sponsor being somebody who is going to manage the investment, right? And they're backed by investors, right? And that can be, there are a couple different, well, probably a lot of different structures, but two main structures. One being a funded private equity group where they've got a large fund of committed capital that's ready to be deployed and acquire businesses. And then there are people like us, the unfunded sponsors, right? And so what we do is we have a network of high net worth investors who, we raise our capital on a deal by deal basis. And so, I think at a high level, the I'm a little bit biased, right? I am a huge proponent of the unfunded or independent sponsor model. In my own way, I kind of think that the funded model is kind of everything that's wrong in the world of private equity, right? And what you see with a funded sponsor is that from my perspective, again, it perverts incentives a little bit, right? You raise a large fund of committed capital. Now you're under a lot of pressure to go out and deploy that capital, right? And so from the investor side of things, you are likely paying a little bit more for companies, right? Just to get deals done, to get capital deployed. From in our model, right? We have to be patient. When we buy a business, now we have to go sell that deal to our investors for them to invest. So it's just a little bit different dynamics on the back end from the buyer perspective. But, I think it's important for a buyer to kind of understand, I guess, the two different players there. And not to say, there are, many, many really, really good private equity funds out there with committed capital that have, a really great track record, right, of being successful, with their acquisitions. But again, from my perspective, running it as an independent sponsor, really, again, you have to be more patient. You have to be a little bit more careful, right? I guess in how you in the businesses that you acquire. Yeah, you got to be a little more intentional. What I think the good thing from the seller's perspective is, with the independent sponsor, I think in a lot of ways, the way that the deal gets structured, the multiple that they're going to pay, the likelihood of success for your business on the post transaction is better, right? The whole model isn't predicated on having to make major changes to the business for it to be a going concern post transaction.
Okay. All right. So now let's talk through, how do you find these, manufacturing businesses that target, say what, 2 to 5 million EBITDA, maybe down to 1 million. How do you find them? And then maybe let's start kind of introducing the idea of the investment banker, the broker, and what does it mean to go directly? You guys finding them directly, and then where does this investment banker, broker, how does that come into play? So talk to that a little bit.
Yeah. So for us, it's all about deal flow, right? For the value that we're providing to our investors, our looks at different companies, opportunities to invest across a diverse range of businesses. So having really good relationships for us with investment bankers and brokers and business owners is really critical, right, to the success of our business and our model. So from our perspective, the way that we look at it is, there are a lot of investment bankers, right, that are usually representing kind of higher quality deals, right? Assets that are probably going to trade for higher multiples or, just larger deal sizes, right? Because for them, it's all about the fee, right? And I think it's obviously something really important for a business owner to consider, right, when selling is, hey, what you may get a little bit more, right, going with a higher end investment banker, but you're going to pay more in fees, right? So it's thinking about what's the right balance there. Higher end investment bank is going to be able to market your deal better. They're going to know more buyers. But, the idea is they'd be able to find a better fit for you, who's willing to offer you more for your business. And I would say there's a gradient, right, of quality of investment bankers too, right? There are here in the Twin Cities, we've got a lot of great lower middle market investment banks. One I think you may be having on your podcast in the near future here as well. And then I typically think kind of a tier below that, and it doesn't have to do with the broker themselves. It's just who the business owner they're targeting, right, to represent. So brokers are usually representing smaller deals, and they're a little bit more passive. They may not have the same size of network of a higher end investment banker, right? So, but their fees are going to be smaller, right? So it's a bit of a, you get what you pay for. Personally, from my perspective, just depends on your business. There are some businesses where I think you probably will get a lot of value out of hiring a higher investment banker or an investment bank that specializes in the type of business that you have. For some businesses, we look at a lot of machine shops,
Yeah.
precision machine shops. And I think in that case in particular, those typically, I mean, I don't want to say that they're totally, interchangeable, but a job shop like that, it's going to trade for unless there's something really unique, right, or differentiated about that business, it's going to trade for a pretty narrow window,
Sure.
on just the value. So, it doesn't make a ton of sense to go and spend a whole bunch of money, on a high end investment, and they may not even want to be interested in, taking your business to market, right? So, I think you got to think critically, right, in those types of situations. It may just be better to go direct and try to sell your business to, maybe somebody or a group like us who would be interested. Where at the end of the day, you're going to take more money home.
Okay, so how do you find these deals? I understand that sometimes it actually the investment banker, the broker might be coming to you, but outside of that, like, how are you guys finding these machine shops and like, what does that even look like?
Yeah, I spend a lot of time building relationships with people, right? I mean, so for me, it's about you know, uh, meeting people, creating relationships, letting people know, who we are and how we do things. In a little bit more detail, we worked really hard when my business partner Ryan and I got Duco off the ground in getting to know a lot of CPAs and accountants, because I have existing relationships with a lot of business owners and they're a trusted party. It's the same thing with attorneys, right? There are a lot of great attorneys here in the business attorneys here in the Twin Cities, and so getting to know those folks, right, and trying to get leads to business owners directly that way. It's especially owners who are not interested in trying to broadly market a deal. Um, we spend a lot of time at with different industry organizations, trying to get to know people. And then another way, I think I mentioned a part of our how we differentiate ourselves is in having a large network of CEOs in transition and CFOs, and a lot of these people, a lot of them are in transition, like I mentioned, and so they're meeting with other businesses, and they're looking for their next role, and so we've gotten leads and connected with business owners through those folks as well.
Yeah, and I want to spend some time talking through that whole piece of the how you guys will plug in a CEO. And then I actually think it's really fascinating, like that's how you're using it to like network to kind of find these opportunities. Um, but before we do that, so now you are introduced to the target business that you're looking to acquire. Like, let's just start from the beginning. Like, what does that even look like? What are they going to hear from you? Like, hey, we have interest, and like just talk through the process kind of at a high level.
Yeah. So, I think there's kind of the very first thing, right? It's just feeling each other out, right? Like, who are these people? What are their values, right? I mean, is this somebody who, you can trust, who you'd be interested in working with, right? Even if there is a deal to be had. And then, typically it's hey, okay, like let's sign an NDA. Let's get that in place and let's kind of take a look at the financials and see what's been going on the last few years. We typically look at a 3-year window, which obviously has made things interesting with COVID, right? And everybody's financials kind of being all over the place. But and if need be, we maybe we look back a little bit longer. But we want to see a history of stable cash flow, right? I mean, at the end of the day, that's kind of what is going to help us get more comfortable around a deal. We will, at that point, it's like, hey, if we can, we'd love to come, meet or, take a look at your business, maybe meet some people on the management team, if that's on the table. A lot of owners are obviously a little bit skittish at kind of letting you in to look at things. Maybe it just kind of depends on how far along they are personally and kind of like psychologically and selling their business. So that's maybe a whole nother conversation, but it's kind of getting folks comfortable and getting us comfortable, right, with what this business looks like. And then, at some point, you kind of want to, what we'd like to do is we like to put a range out there, right? Like, hey, here's what we're thinking, right? Just kind of at this initial point, right? We've gotten a quick look at your business. Usually we'll put a range out just based on the financials, right? And then we'll go look at the business, right? If we're in the same realm, right, then it's like it's worth both parties spending a little bit more time on. After we take a look, we do kind of which is all part of our own kind of initial due diligence. Then we're going to put our heads together internally, right? Our team, and we're going to come up with a number, right? That will, actually it's a number and a structure, right? So, I think people really tend to focus on price for a transaction, but the way that a deal can get structured, to get to that price is there's a lot that can happen there, right? I don't know how far into the weeds we want to go in with that, but I think at a high level, right, it's the cash consideration, right? What at close, here's what you get in cash, right? And then maybe there's a seller's note or an earnout, right? We typically don't like to do that if we can avoid it. They're the only way that we're likely going to do an earnout, barring some other things that may be going on in the deal, is if the owner is going to be sticking around, right? Because the last thing we want to do, put an earnout into the structure, and then the owner leaves, something doesn't go right, and the earnout, those numbers aren't hit, and then you end up in a legal dispute, right, on whose fault that was, or whatever. So
let me back up a little bit and just let's go back to that purchase price, because I think the business owners are always like, hey, what are you going to offer my business? And probably have an understanding of like multiples, right? Business owners talk, especially in that space. What would drive a higher multiple from your side, right? Like, what do you see to say, we'll pay on the upper end because this looks quality? What are some of those components?
Yeah, I think some industries are, a lot of times you're looking at comps, right? Like what are some other similar businesses that have traded recently, right? And is there something about that industry where people are willing to pay more, right? So, but some of the things that I think can make that industry more attractive and people willing to pay more, is that if you have recurring revenue, right? If you've got contracts or you've got something about your business that creates a high confidence around recurring revenue, right? I think that's a big piece of it. Businesses kind of like I mentioned machine shops, right, or job shops. In those cases, it's a lot of just relationships, right? And there's nothing to guarantee when that owner walks away that business is going to stick around, right? So for us, it's all about getting more comfortable and more confidence around, what that business is going to look like post transaction. We like to see opportunities to operationalize a business. So for us, it's like, hey, we want to buy a business where there's opportunities to grow the business, right? But we're not going to pay for the work that we have to do. Right. And I think, a lot of owners, sometimes, a lot of times it's like, hey, next year this business is going to do really well. Right. There are all these things in place. And, we've got some verbal agreements with some customers and it's going to be a really big year. For us, that's a hard pill to swallow. Right. And we sometimes want to give credit for some things. Right. I mean, but generally speaking, we don't want to give credit for things that we're going to have to do. Right. or synergies that we're going to create. And so there's always that kind of natural tension, I think, between obviously a seller and a buyer, right? It's a little microcosm of human nature.
Yeah.
So whatever you can do to create confidence around, the revenue and cash flow, I think is only gonna increase your multiple or whatever the EBITDA that the buyer is going to base the multiple off of.
Okay. All right. So now you put out this kind of range of purchase price, and business owner says, "Hey, yeah, let's kind of move forward on this." Then what happens?
Yeah, once you've agreed on a price and a structure, right now, and usually that gets spelled out in like an LOI, right?
LOI
which is
stands
a
for.
yeah, it's a letter of intent. And so you'll have just kind of the high level stuff outlined in the deal. Hey, this is what we're all working towards, right? And that once you get a signed LOI, which I think a lot of sellers, and not unrightfully so, but look at that as signing an LOI. A big part of an LOI is exclusivity, right? So now you've got a period where it's like, hey, we're committed to being kind of an exclusive relationship with each other to drive towards this finished goal of a transaction under the terms dictated in the LOI. Um, things can change. What one thing that we try to do well, again, trying to be good buyers, is not retrading deals, because that can happen, right? But as soon as that LOI is done, you kick off your due diligence in earnest, right? And from our perspective, there's kind of two phases of due diligence. There's the confirmatory diligence, which is, hey, is this company what was told to us a couple of weeks ago, right? So everything that we've been told, is this really what it is, right? So we, essentially, this is probably the most painful period, especially for sellers, right? Where you're forking over all kinds of paperwork, right? All kinds of details around your business, things you probably haven't thought about in a long time, right? But obviously, a buyer wants to know as much as they can. And then after that confirmatory diligence is done, now it's more of like a transition diligence, right? Where it's hey, okay, now we got to start thinking about handing this over, right? Like post transaction, do we have everything in place to make sure things go as smoothly as possible?
And you said retrading deals. What does that mean?
So, right, I kind of jumped around a bit, but yeah, so for retrading a deal is like, once the buyer starts getting into the doing their due diligence, maybe a couple things pop up, right? Now, a good buyer is going to be able to take some of that in stride, right? A bad buyer is going to start immediately start things apart and try to retrade, right, or try to renegotiate the terms that you guys have already negotiated in the LOI, right? So maybe they'll say, hey, now we got to take $1 million off the price because this isn't kind of what you represented it to be before. So I think there's an element of like doing some good diligence ahead of pre LOI, right? So that you're generally comfortable. But it's just I talked about human nature, right? Like you need to you can't if your mentality is like, hey, I'm going to come in, I'm going to give them a really high price on the LOI, get it under LOI, get exclusive, and then just start hammering them on stuff and drive that price down, you're going to kill your reputation, right, as a buyer. So there's some strong reasons to not do it, but that doesn't mean that it doesn't happen.
Okay, that's what I was gonna ask is, how do you know if they're, as a business owner, how do you know if they're a good buyer or a bad buyer? You're saying reputation is key, and so just kind of validating that and just getting, sometimes how do you know? But like, I guess reputation probably carries some weight, and that could probably come out pretty easily if you're seeking that out as a
Right.
business owner.
Yeah, I would highly encourage. I mean, and I'm sure most people do, but if you're selling your business, do a little bit of your own diligence, right, on the buyer ahead of time. What is their reputation? I mean, do they have a reputation? Because frankly, I mean, up until recently, we didn't really have much of a reputation. We've only been around 2 years, and so it's been a lot of work for us establishing that reputation with key players, in the market. So a lot of the CPAs and attorneys that I mentioned before, right? Getting in front of those folks and kind of telling them who we are and how we do things.
Okay. All right. So now the due diligence, the whole quality of earnings, we feel good, and we actually, come to the table and we close on the deal. And as you said before, you guys are targeting more of that owner that ideally they want to be fully out for whatever reason. It could be health reasons, it could just be, they're burnt out, it could be retirement or whatever, right? And so kind of on the other side of it is you guys are networking with these CEOs in transition, right? Because if I understand it right, you're kind of interviewing like who are you going to plug in to that business to run it, right? Because
Yep.
you, private equity, like you're not, or you're overseeing it, but you're not going in and running it, clocking in every day, 7 to 5 type of thing, right? That's where you bring in these CEOs. So
Yep.
now like the business owner has sold it, right? And let's just talk about from your perspective, what does life look like with that business where a new CEO comes into play? And maybe even like shed some light on like how do you even find the right CEO? I think it's
Yeah.
two-part question. Maybe not
Yeah.
related.
Yeah. No. That's I mean, that's what I've spent the last few years kind of trying to figure this out, right? So, one of the challenges in having a network of CEOs in transition is that they're only in transition for a certain period of time, right? So, it's not a small amount of work to get connected with people who are interested in, running these lower middle market business, manufacturing businesses. I meet with 2 to 3 folks a week, and we've got, I think we're pretty well networked in kind of that space. So for us, as soon as we get a deal under LOI, we're going out to that network of folks and being like, hey, we just got this deal. We know some people that may, or depending on the business, right, that may or may not be a better fit. So I wouldn't say it's just going out broadly to the universe, right? I mean, we're going out to, some, I would say, strategic folks who we have under NDA, and we'll reach out to people. Hey, are you interested? Then once we get a few people who are, we interview them. What we're looking for, it is not necessarily that they have specific experience in that industry. I think some businesses lend themselves to people without that specific industry experience, whereas some businesses may require some deep experience within that industry. But I guess that that's another kind of decision point for us. But generally what we've seen is that we want people with strong leadership backgrounds, and I think there's a little bit of a military angle to kind of how we go about this. I'm a veteran, and I network with a lot of other veterans, and I think especially in this lower middle market manufacturing space, veterans can be a great fit from a leadership and cultural perspective for these businesses. So, we're looking for people that have demonstrated experience managing and leading people and teams. So I'd say that's probably the most important to us. Another thing that, depending on the type of business or the size of the business, we've looked for people who we thought would be a strong cultural fit. Right. So, we may not always go with the CEO that has the best resume, or has managed the largest organization. It comes down to personality, right? And do we think they're going to mesh well with the people already in the organization?
Okay, and I want to come back to the whole military veteran piece because I'm interested to see how that impacts that just from your side of it. I'm sure there's some interesting kind of commonalities between the two. Before we do that, talk me through we talked before actually offline about the CEO kind of like compensation structure. where, you know, a lot of times, right, that um, ownership equity is going to be part of that CEO comp structure. Why is that done?
Yeah, so we want to get everybody in the boat rowing together, right? And having, I think it's twofold. One, it's an opportunity for these CEOs to bet on themselves, right? Having a significant ownership stake of the business. So yeah, maybe kind of spell out a little bit more of what we do, right? We require our CEOs to invest into the deal, right? And we'll match 50% of their investment with additional equity that vests over 4 years and is tied to performance, right? Again, we want to incentivize our CEOs to put as much into the business as they're willing to. We just want to see it to be. It just needs to be something that's significant to them. And again, it's to align everybody's interests, right? So we're all kind of marching towards the same thing. We are not a high touch management group. What we work to do is to empower our leaders to make the decisions and do what they feel like is best for the organization, because we're all, again, in the boat together, right? They're incentivized the same way we are for the long-term success of the business.
And sometimes that CEO that you plug in day one after close, they may not be the one that's going to be there long term. Like, that's just kind of interesting that we've talked about in the past, that like there might be CEOs that are better apt to, like, kind of plug in and transform the company compared to a CEO that is gonna run the company long term. Is that?
Yeah. So, we think we do things maybe a little bit differently than some other private equity groups. There are some like bigger PE groups out there that do more of what is called like the operating partner model, which is kind of what you were talking about, where it's like, a CEO parachutes in for, a year or two to make some, major changes in the business. And then, they pop off to the next portfolio company, for the PE group. We are more of a buy and hold private equity group, which is, maybe an important difference that we didn't talk about earlier. But we look to hold our, I would say we're flexible, right? I mean, if somebody comes in and makes an offer, we couldn't refuse on a business, we may do that. But generally speaking, our investors don't want, their problem is like too much cash, and so they don't want large liquidity events.
Yeah.
And so, our bias is towards long-term hold, which is a flexibility, again, that you can't get within a fund. There's typically, well, not that you can't, but typically you don't see that kind of flexibility. Usually in a fund, there's a mandate to sell the business in, 4 to 7 years, somewhere around there, just to, fit within the life cycle of the fund.
And that could even be from the business owner perspective of like kind of interviewing that potential private equity is, if you're selling to that type of fund, just know that likely ownership is going to change in 4 to 7 years. And maybe they don't care. Like, maybe it's like what's done is done. But like, if it's something that like they still want their legacy behind, like that might be a good question for them to ask of like, what's the goals of the private equity fund itself. So that's an interesting take. Okay.
Yeah, no, I think that's super important. And it's I mean, and that's why I think, we don't do the operating partner model, right? Like, we're not parachuting CEOs in to make those big operational changes. We have a much more long-term lens, right? And so the CEOs that we're bringing on, and why I think it makes sense for them to be, significant investors, and to bet on themselves, is because we're looking for a 10-year or so commitment from our CEOs in each of these businesses.
Okay. Now we gotta, give some love to the military background. So thank you first for your service.
Thank you.
Where did you serve?
Well, in Afghanistan. So I was on Team 4, deployed to Afghanistan. Did a 9-month deployment there.
This was the Navy SEALs, right?
Yeah, sorry. So yeah,
Yeah.
take a step back there. So yeah, I was a Navy SEAL. Joined after college. I enlisted, and then like I said, made it through buds and ended up going out to Team 4, deployed to Afghanistan in 2012, 2013. And then ended up getting out after I got back, moved back home here and did my MBA at the University of Minnesota, Carlson School of Management. And that's actually where I met my business partner, Ryan. So that was the genesis for Duco.
Oh, interesting. And there's
Yeah.
got to be, I would think, I was never a Navy SEAL, but just the part of like level of due diligence that you're doing, before the operation itself is probably, a commonality, and even just the tenacity, because I know these deals aren't always just like the journey that you think that you're going to go on type of thing. But just, I don't know, connect the dots. Like how is the military background kind of served you well in what you're doing today?
Yeah, I think you hit on a couple things. For me, I'm just much happier doing things that I think are a little bit higher stakes. For me, it's a bit of and I don't know, this is kind of over, I don't want to frame it this way necessarily, but it's like the thrill of the hunt, right? It's
Yeah.
much more engaging and exciting
Yeah.
for me than, I worked at another, a great company, Ecolab, for
Yeah.
a few years, and great people, good company. Just that sort of corporate work didn't fit my personality.
Mhm.
It was kind of my take on it. I need to have an opportunity to have a little bit more risk, but it's calculated risk, right? To your point on, the kind of pre due diligence that we put a lot of time and effort into analyzing a company and an opportunity, because as we move forward, right, we either want to give people a quick no, or hey, this is interesting to us for X, Y, and Z reasons,
Mhm.
and be as transparent as we can and get moving, right? We don't want to waste people's time, but yeah, there is that kind of like okay, this is a risk, right? Buying a company, doing a transaction, there's risks involved there, by the nature of it, there's just that element of preparation, right? And understanding the risks that you're going to take and then pulling the trigger and moving forward.
Yeah. All right. So as we kind of conclude here, um, maybe speaking more directly to kind of the audience of the business owner side of it, like what is, maybe we've covered enough of it, but anything else, like what's good to know, and what should we come to expect from private equity, and maybe even just kind of getting their heads around of like this could be their potential exit option. Is there anything else that we missed that we really need to highlight?
In my mind, there's two things that I would like people to take away from this conversation. The first is that there are a lot of different types of private equity out there, right? Like, just like there are a lot of different people, there are a lot of different types of private equity groups, the way that they are structured and function, and the people within them. And so I think for sellers doing their due diligence, right, on who those groups are and who those people are and how they operate is really important. And then the second thing, and what we see as like the number one deal killer, is the attorney.
Uh,
So, and I don't, and it's probably because I'm on the other side of the table, right? It maybe doesn't come across as good, but there are a lot of great attorneys out there, business attorneys, right? And what we see is a lot of business owners develop these really strong relationships with their attorneys, and that's great. But an M&A attorney, a deal attorney, is kind of like, it would be if using your business attorney as your deal attorney. Most of the time, I don't think they're up to the task, because it's like a different language, the M&A stuff. And so it'd be like asking your general practitioner or doctor to perform knee surgery. It's just not the right fit. So there are a lot of really good M&A firms in town, and I highly recommend people go to a real M&A attorney who is only doing deals. So it's what they do, and they specialize in that, because what happens is that the terms that you see in deals kind of evolves over time, right? And what's market, what's normal changes. And so even if your family, business attorney has done a deal before, maybe it was a few years ago, maybe they do one or two a year, they're not going to be up to date on what's market now, and it'll kill the deal.
Okay. Yeah. That's good. That's very good, strong feedback is, know the players, that
Yep.
can represent you and just get to know that potential buyer just as much as you're trying to get to know the seller. Is spend some time. And probably this transaction for that business owner is probably the biggest transaction of their life, and likely one of the biggest life events too, where we kind of come in on the wealth management financial planning side to help kind of understand the before and after that. But Caleb, this conversation has been awesome. Thank you for spending some time with us. And man, you really provide a lot of kind of insight to our audience. So thank you, Caleb.
No, yeah. Thanks again for having me, Brian.
Yeah. If this topic has interested you as a business owner and just trying to put together all the complexity of business ownership, but more so how it impacts your own personal finance, that's where we come into play. And help putting it all together is, how would this potential exit from your business to private equity impact your own personal financial plan, the before, the during, and the after? Get eWealth Partners involved. That is what we do. We target business owners, and that is our expertise. So reach out to us, and we'd love to start the conversation with you.